Alright, so I hope you guys are enjoying this rally. So as we anticipated, a couple of months ago, we said that by the mid of the year, markets will rebound. That's what we knew, right? And I said that one of the keys is going to be when inflation peaks, that's going to signal the bottom in the market. So all that has come true so far. So indeed, we had a bottom on the 16th of June. And since then, let's do a measurement. We are up for the last 8 weeks. Let's see. Measure from here all the way to the close of yesterday. We are up 15.74% as of the last 8 weeks. Now, we had actually a strong level of support and resistance over here that a lot of people thought, okay, we're hitting resistance and we could be coming back down. But what happened was on Wednesday, they announced really encouraging inflation report on the CPI that inflation was coming down again as we anticipated through the leading indicators. So no surprise, but that confirmed it. So the moment that happened, we had the market boom gapping up, as you can see, gapping up above that level of resistance, and we closed slightly bearish yesterday. Today the futures look bullish, but we're going to see what's going to happen now. So of course the big question is this: is the bear market over? Was that the absolute bottom? Well, I've said this before that technically it is not a bull market yet. For this to be a bull market, there must be two conditions that are met. I've said this before, right? What's the first condition? The first condition is that the 50 moving average, which is this blue line, has to cross back above that 150 moving average green line, and they both must start sloping up. That confirms the new bull market. Or the market closes above the 200-day moving average, which is this red line, and the 200 slopes up. That's also a confirmation. But again, the trouble is, by the time that happens, prices will be a lot higher, right? So many people, if you're going to wait for the bull market confirmation, you'll be getting in really high already, where the market has really moved up substantially. And of course, if you're one of those that sold in panic and you buy it back so high, it doesn't really make sense. Now, there's another condition that can be met for a bull market to be confirmed, and that is when prices rise 20% from the lows, right? So this was the recent low. So what's 20% from there? Now, if you measure it, you can see that from that low over there, a 20% move up would be this line over here, which I've drawn, right? So this line is 4364, and we are not there yet. We are not there yet. Okay, we are not there yet. We're close. We're not there yet. But interestingly, if you look at the Nasdaq has already closed 20% above the lows. So if you read the Wall Street Journal and Barron's, they already said that the Nasdaq is in a bull market. Now, I'm not calling that yet because I've seen historically through past bear markets, there are many times when it did close 20% above the low and it was a technical bull market, but it failed, right? So to me, it has to go 20% above the low and stay there for at least 30 days. Then I would say, all right, it's a bull market, it's confirmed. So we're not there yet, okay? Now, again, if you listen to people out there, the majority of people still believe that, you know what, this is a bear market rally. This will fail. They're so convinced that this will fail, right? This is, it's going to get worse. We're going to rally up somewhere here or somewhere there, and we're going to go much lower. So again, the majority of articles you read in the media are all believing that scenario, that this bear market is not done. We're going to go lower. This is just a bear market rally or suckers rally, right? Bloomberg, bear market bounce will be short-lived. This was just 2 days ago. Some experts are warning of a bear market rally. Bear market rally likely to lose steam. Bank of America. So are all these prophets of doom correct? That this is just a suckers rally, it's a bear market rally, it's setting up. If you're buying now, you're a sucker because it's going to make a lower low. Maybe. But if the market is able to retrace 50% from its initial decline, they are all going to be wrong. And I can tell you with almost 100% confidence that there ain't going to be another low. What do I mean? Now, if you take the high of the market, that's the high of the market, right? And that's the low of the market. Now, if you use a Fibonacci retracement tool over here and you click at the high, let me just click at the high over there, boom, all right? And we drag it all the way to the low, okay, all the way to the low, somewhere there, boom, okay, there we go. can you see this 50% level? Right, it says 0.5 50% level. Now, what does this mean? Let me explain. So what happens is that this move here, let's call this A, which is the top, and B, which is the bottom, right? So from A to B, that's what we call a entire decline. Now, if the market is able to rally and close above the 50% mark, in other words, it's able to kind of like make back 50% of the decline and close above that level, then the bear market is over. There will not be another low. Now, how do I know that? Very simple, because I've studied all the bear markets in history since the beginning of the S&P 500, which is 1957, right? So in the last 65 years, during a bear market, after the market has dropped 20%, every time the market is able to retrace more than 50% and close above that level, it has never ever gone down again. And I'm going to prove it to you and show you all the past bear markets, okay? So in other words, for this case right here, right now, what level are we looking at? We are looking at this level of roughly 4226.33. So let's round it off to 4227. So 4227 is the line in the sand, all right? And let me kind of like use this line and let me draw it out for you here. Okay, so 4227, right? 4227, okay, thereabouts. Okay, now, have we closed above this 4227 level? No, we have not. In fact, yesterday, you can see we attempted to close above it, but it got rejected. So we closed bearish, okay? So we may be going down. We'll see how it goes, all right? So this may take time, okay? It may happen today, next week, next month, I don't know, okay? But the moment the market is able to close, the candle is able to close above this level, I can tell you with 99% certainty that the market will not make a new low. The market is going to go up from here, not in a straight line, up and down, but it will not go lower than that low. Now again, let's take a look at history and let's see if this is true. Okay, so we're looking at the S&P 500. The S&P 500 was actually introduced on 4th of March 1957. So since then, we have had 1, 2, 3, 4, 5, 6, 7, 8, 9 bear markets, not including this current one right now. Okay, now this 1956 one is based on the Dow Jones index because the Dow is like 120 years. So we're looking at the S&P 500. So we're going to be looking at these bear markets prior to this current bear market, and let's see whether this theory really holds. Okay, so let's go backwards and let's take a look at the previous bear market, which was 2020, 2 years ago. So that bear market began over there, right? So first we have to see where was the 20% decline mark, because once it declines 20% and it rallies 50% from the lows, then the bear market's over, all right? So if we use this tool over here, you can see if I again draw this at the top and we scroll down, okay, this is the 20% level over here. Okay, so notice that I've drawn this line to represent 20% decline. 20% decline. So remember, once we have a 20% decline, then it is officially a bear market. Okay, so once it's a bear market, did it retrace more than 50%? Let's take a look. Okay, so you can see that the market went down. Now you can see in this case there was no retracement. The only retracement was this guy. This was the first rally over there. And you can see if I use the Fibonacci tool, again, if I go to the top and draw it to the bottom, and that is my 50% level. Can you see that 50% level over there, right? So A to B. Now, once it closed, you can see this was a close, okay? Once it closed above the 50% level, hallelujah, it never went back down again, right? Of course, it dropped temporarily, but it never made a new low, right? It resumed the next bull market. So That worked for 2020. Now, let's go back before 2020, which was the financial crisis, which was 2008, 2009. Okay, so we are back to the Great Financial Crisis, which officially started in October 2007, which was the top here before this bear market started. So again, where was the 20% decline mark? Let's use the measurement tool, and that was the top, and this was exactly the 20% level over here. Right, so this was the 20% level. So the moment it hit this level over here, this was then a bear market, right? So after the 20% level, did it retrace more than 50%? Let's take a look. So first of all, where was the first retracement? Now, this was the first retracement. This was the second retracement, or we call it the rally, right? Bear market rally 1, bear market rally 2, and bear market rally 3 eventually resumed the bull market. So was this a 50% retracement? Was this a 50% retracement? Let's check it out. So again, use my Fibonacci tool and click on the top over here, right? And all the way to the bottom. So initially, this was the low. This was the first low, right? So you can see that during this rally, it did not reach the 50% mark, okay? In fact, it didn't even reach the 38% mark. So this obviously failed. So that did not work. Now, how about the next low? This was the next low over here. This was the next low. And again, you can see that this rally from the bottom, it did not reach the 50% level, all right? And then it failed again. And then we had the next low over here. So let's bring it down to this new low over there. All right. And did this rally reach that 50% level? Yes. So it closed above this level. Now, when did it close? It took some time. Let's kind of like push this here. Yep, there we are. Okay. So I'm going to zoom in so you can see this a bit clearer over here. All right, so again, that's our 50% level. That's our line in the sand. And it closed above the 50% level right here. Okay, right there, it closed. So once it closed above the 50% level, did it ever go back down again? No. All right, sure, it went up, it came down again, it went up, it came down again, but it never came back down. It never made a new low. And of course, that went all the way up to a new top. So again, it worked in the Great Financial Crisis. Let's go to the one before that, which was the dot-com crash. Okay, we are back in 2001, 2002, the dot-com crash. I remember this vividly because I was in a university. All right, so where was the top? The top was there. That was the top of the market. And this line here is after it dropped 20%. Okay, so it dropped 20%. And the bear market was declared right below this level. Okay, so once the bear market was declared, how many bear market rallies were there? Well, there were a couple of bear market rallies. So first, we had this first bear market rally. There was bear market rally number 1, failed, right? Bear market rally number 2, failed. Bear market rally number 3, failed. So there were 3 bear market rallies. Did any of them close above the 50% retracement level? Let's take a closer look. All right, so let me zoom in the chart over here. Let's zoom in the chart. And let's go to the Fibonacci level tool. Click on that. And again, I'm going to bring it to the high over there. That's the high. And let's go to the first low. So that's the first low over here, right? Okay, click on that. Great. So that was the first low. And this was the first bear market rally. Now, did it close above the 50% level? Yes or no? No, it did not. You can see that it just touched that level, right? It touched it and then failed. It did not close above it. Then it made a new low over here, right? So now let's drag it to this second low. So let's drag this over here to this second low. And did this reach the 50% level, right? So it rallied, did not reach 50% again, right? It only reached the 38.2% level and then failed again, okay? And then it made a new low. Here, this was the new low, right? So again, let's drag this down, okay? And did this rally, this is rally number 3, did it reach the 50% level? No, so it failed again. So again, if it can't close above 50%, it fails. Can you see that? All right, now finally, it made the low here. So this low over here, let's bring this down to this level. Did this close above the 50% level? Yes. When? Right there. Okay. So again, 50% level, right? Can see that now this low was the ultimate low because it retraced and it closed right there. Can you see the close over here? It closed above that 50% level and then it never went back lower again. Sure, it did go lower. It went below the level again, but then it took off and made new highs. So again, it worked for the dot-com crash. Let's go back the previous bear market. So the previous bear market before that was 1987. And this was a very, very sharp bear market. So again, that was the top and it went all the way down to the low. And you can see it retraced to the 50% level again. So again, 50% level, it closed above that level right there. Okay, so once it closed above the 50% level, it never went down again. Sure, it went up, it came down, but it made, again, a new high. The one before 1987 was 1980. So again, that was the top of the 1980 bear market. That was a 20% level. So once it dropped 20%, we had one rally over there. First bear market rally, second bear market rally, and the last one succeeded, right? So did this first bear market rally retrace 50%? Now this is debatable. It actually did close above the 50% level for just a day, right? It was kind of like a touch and go and then it failed, right? So this is a bit debatable, right? It did close, but it was not a solid close way above. It was kind of like a touch and go, right? The second one did not come close to 50%. The third one was a solid close. So the third one, you can see, that's a 50% level again. It closed right above that. And once you got a solid close, it stays there. Boom. Never came down again. The one before 1980 was 1972, which a lot of people compare this bear market with 1972 because that was due to the high inflation as well. So 1972, you can see that was the top. And again, this black dotted line, that's a 20% level. So once it hit 20%, bear market. How many bear market rallies did we have, right? We had a rally there, rally 1, rally 2, a few small ones, right? Rally 3, 2 small, rally 4. So they were all very small rallies that just could not get 50%. So they all failed. And this last rally over here, it closed above the 50% level there. Make it clearer, that's a 50% level. So we had a solid close above that level. Once we close above that level, we never saw a new low again, right? It would make all-time highs. So again, in the interest of time, I will not go through all the bear markets, but you can do it yourself, right? You can look at all the historical charts and do your own measurement and see for yourself back in 1968, 1966, and 1961. So this is a chart to kind of like summarize what I've shown you so far. So the green arrows represent when the market has retraced 50% of the decline. Once the market has fallen into a bear market, which is a 20% decline. So you can see the last time this happened was a dot-com crash. The pandemic, right? So retraced 50%, made new highs. Drop, retraced 50%, made new highs. drop, retrace 50%, make new highs, 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 drop, retrace 50%, make new highs. So do you get the point? The point is that we are at a critical level. We are near a critical level on the S&P 500. That's our 50% level, and we are just near there. We got rejected yesterday, and let's see if we can close above this level today. Again, I don't just want to see a touch and go, because that could still fail, right? I want to see a solid close above this level. Now again, it could happen today, next week, next month, I don't know, right? But once we have that solid close with a bullish candle above this level, there's a very, very high chance that we will not see new lows again this cycle, and we're going to make new highs by this year, end of this year, or by next year. But again, don't expect the market is going to go up in a straight line. Okay, remember, we will have ups and downs. In fact, you saw from the previous bear markets that even after you get a solid close above, what tends to happen? It tends to go down again, right? And it goes up again, goes down again, and then eventually it makes new highs. So don't freak out if it goes back down again, right? But the point is that if it goes back down again, those are dips that you want to buy. In fact, September and October are coming. And as you guys know, historically, September and October tend to be bearish months. So I do expect this rally to have a pullback, a big pullback in September and October before we hallelujah all the way to December. Now, do you remember this decennial chart which I showed you? And this is again from Larry Williams, the legendary trader. And you can see so far this has played out really closely this year, where we had the first half of the year from January all the way to middle of June, the market was bearish, right? Exactly what happened this year. And from the mid of June, we're now in this rally phase. So coming to September and October, I do expect again a sharp pullback here, which for those of you who missed out and you want a chance to get back in, you can wait for this pullback to get in here before the next hallelujah all the way up. All right, so let's see if this plays out. Again, there's nothing 100% in the market because there's so many variables, right? I mean, we could get a fantastic close. We could have like 99% is going to go up, and then China attacks Taiwan, World War III, and all bets are off the table. So remember, as an investor or trader, remember that you got to have the mindset that anything can happen. So you got to be prepared for all scenarios. As a trader, if you're getting in, have your stop losses ready to get you out if it fails. And have your profit targets to take profit off the table when you get a good run. For investors, it doesn't really matter. As investors, remember, we buy great companies that will always go up in value over time. And most of the companies that I own are recession-proof, are pandemic-proof. And I keep adding to the positions. If it goes up, in a way I'm happy, but in a way I'm not happy because I can't buy more because it's no longer cheap, right? But if it goes down again, then I'm happy because I can keep adding more shares. Because when I take a long-term view, I know that in 3 years and 5 years, it's going to be a lot higher than where it is today. So whether you're an investor or trader, the point is stick to your investment plan, stick to your trading plan, and this is to just show you scenarios that could potentially play out in the market. Hope you enjoyed it, and I'll see you guys in the next video. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com, where you're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.